Hi, this is David Guest. Yesterday we ran a workshop, which I forgot to record, about how to set and achieve your profit targets in your business. One of the hardest things to do with a business is actually establish how much is enough, or what's possible, or how should we set our profit target? How much should we make? Now, I'm going to give you a couple of rules of thumb, and then I'm going to go through some technical stuff as well. But overarching, here's the number one principle. If you've decided to go into business in the first place and you're not sure what your revenue or profit targets are, as much as possible is not a target, okay? What you need to do is you need to put a reference point in place. So the easiest way to do this is if you think about your business as a source of income, if you need the money for survival, probably the primary thing you need to think about is, well, what am I sacrificing to run this business? Now, for most people, that could be a job that they could possibly have. Now, the nice thing about having a job is that you get paid a wage. It's the same amount every week. You get superannuation, you get long service leave, you get holiday pay and sick pay, right? So you're covered on so many angles to take the risk out. So when you decide to sacrifice that to run your own business, what you need to be thinking about is not just replacing your wage, but accommodating the risk involved in running your business. So as a rule of thumb, this is what I suggest you do. Work out how much you're worth in the marketplace. If you went looking for a job, how much are you worth? Or how much do you believe you're worth? Or how much do you think you can earn? So that becomes a base number, because that's how much you're giving away straight away as you decide to transition from a job employment into your business. Now let's say, for argument's sake, that is 100K a year. Could be higher, it could be lower, it really doesn't matter. What matters is that you know how much you're sacrificing to go into business. Now, when we start thinking about risk associated with building a business, different people go into business for different reasons. The three main reasons that I've heard is, I want to be my own boss, so the freedom to choose what I work on. I want to choose my own hours, so the freedom to work shorter or longer hours if you wish, whenever you like. Or I want to make more money because I have more to contribute. Now, it could be one of those reasons or another reason for you. But to be worthwhile, you can't transition the 100K that I might be worth in a job into making 100K in revenue or even in profit in your business. My rule of thumb is simple. It's the rule of three, right? So what I mean by that is, if you're worth 100K in employment, you should be aiming to generate 3 times that as profit in your business. Not wages, profit. And I'm going to explain what that means. So 3 times your wage, if it's 100, is 300K profit. Now, for some of you, that's way off the charts. For some of you, that's minuscule. I don't know, right? What I do know is that's the minimum that makes it worth the risk for you to transition into business. And if your goal in business is not to generate 3 times what you think you're worth, if it's less hours, that's fine, then you're probably not stretching high enough. And what ends up happening as a side effect of having low objectives in your business is that we struggle because we're not building buffers. You know, when you run your own business, not every month is consistent. Some months you have good months, some months you have bad months. So let's talk a bit about how we're going to establish what does profit look like. If I can get my iPad to work. 1 second. Cross your fingers. Okay, so let's have a look at this in a pictorial way. So what we have at the bottom here is time. This is the time you're in business. And what we have on the left-hand side is dollars. So understanding where profit comes from and how we calculate it needs us to have a basic understanding of accounting principles. So first thing we need to know is that there's 2 kinds of costs in our business. The first kind of cost that we often see is what's known as a fixed cost. Now, fixed cost could be attributed to things like rent, could be like your monthly services bill, so it could be like your internet service provider, it could be a telephone. Anything that you pay prior to making a sale is considered a fixed cost. And so they call them fixed costs. It's a bit of a play on words. It's not really fixed because your telephone bill could be up and down, but by definition, it's a cost that is incurred prior to making a sale. We have another kind of cost in here. We have what's known as a variable cost. Now, variable cost is something that is zero if you don't sell anything, but as you sell, you actually pay it. Now, this could be either buying a product, it could be paying commissions to salespeople, it could be paying contractors to deliver a service, but by definition, a variable cost is a cost that is incurred as a result of making a sale. So we don't sell anything, we don't pay variable costs, we only pay fixed costs. Now, if we add these two together, what we end up having is a thing called total costs. So total cost is everything it costs you to run your business on a month-by-month basis. And knowing what our total costs are becomes pretty important, because one of the key elements here is it's not about turnover in your business, it's about leftover. And so what that means is it's the gap between your costs and your sales that determines whether you're making money or losing money. So if we start with zero, we're not selling anything. And our objective is to get sales to be greater than costs. I mean, I'm not probably teaching you anything new here, but I just want to point out some really important distinctions. The first one is pretty simple. What happens is when we have our costs as being greater than our sales, so this little triangle here, when we have our costs as being greater than our sales, it's known as running a business in loss. The other side of this coin is when we have our costs as being less than sales. So what happens is this side of this graph, this part up here, is known as running your business in profit. And a couple of key distinctions that you need to understand. And the first one is that we all need to know what our break-even point is. Now, our break-even point literally is the point in time when we make enough sales to cover all of our costs. And then everything after that, we start seeing profitability in our business. Now, the reason you need to know this number is that you need to get to this number every single month. Because if you do not get to this number, you're running in the red. Now, the other reason that this is important is because you'll notice that once we move beyond our break-even point, our profit as a percentage of sales increases, which means our profitability is much, much greater as we move beyond break-even point. Now, once again, I'm not teaching you anything that you probably don't already know, but a couple of traps. So my first question is, as a business owner, I want you to consider where your income comes in, okay? Is it a fixed cost? Is it a variable cost? Or is it just in that profit triangle, the green triangle? Now, for most small businesses, it's the green triangle if we have a green triangle, which means that we don't pay ourselves unless there's money left over. Now, sometimes we confuse the wages of doing our job and profitability, so we pay ourselves what's known as variable cost. So for some people, it's profit. For some people, it's variable cost. And for very few people, they actually consider their wage a fixed cost, which means that I am worth 100K in the marketplace, so the fixed cost of my business is that 100K. Now, how can you do that if you're not making money? Well, what technically is happening is when you're working in a business that's not making money and you can't afford to pay yourself, you're running at a loss. Now, if I don't consider my wage at market value, what I'm doing is I'm actually devaluing my business proposition. So when I think of myself as free, one of the problems that occurs is that I'm always going to be the cheapest resource to do anything within my business because I'm not worth anything. The truth of the matter is I'm giving up my job, which I could have had, so there's an opportunity cost, and then when I add the risk multiplier on there, it's 3 times that. So my 100K is about 300K that it's costing for me to be in this business that I'm not generating. So going back to the original question, how do I set my profit targets? Well, there's 2 things you need to do. Number one is you need to consider what you're worth as the employee in your business, so depending on what jobs you're doing, and you need to put that on the fixed cost line. Now, as soon as you do that, what ends up happening is your fixed costs will take a bump. And when your fixed costs take a bump, your sales will also have to take a bump, and so you'll end up in this situation where this line is now here. And so when we have this line up here, it actually shifts our break-even point, okay? So what happens is our break-even point is now very different. Now, the reason that needs to be is because, sorry, I've done this wrong, haven't I? Let's go back. It's actually our total costs that go up, right? So let's think about that. Our total costs go up like that, which means our new break-even point is much, much higher. So it's here. So what ends up happening is we start not cheating ourselves in our business, and we start realizing that profit is something that we get after all expenses are paid. Our time has a value. Now, going back to the question of how do I set my profit targets? Well, most people work to break even. What that means is that they'll do as much as they can to make sure they can afford to pay their bills. And if there's any profit, it's considered gravy, which means that they get what's left over. And sometimes there's more month left over at the end of the money than the other way around, which means they don't pay themselves. Now, that's a bit of a tragedy in a business, but it's also a reality when you're starting up and when you're growing. So when we do budgets, what we're doing is we're projecting where we need the business to be. And when we look at this graph, most people would say, well, I need to get over break even, and they focus on that number because if I don't pay my bills, if If I don't pay my rent, they're going to kick me out of the building. If I don't pay my employees, they're going to walk out the door. If I don't pay my insurances, I can't trade. If I don't pay tax, they will shut me down. But if I don't pay myself, I suck it up because I'm a business owner, and that's what happens as a business owner. The truth of the matter is you're building debt within your business, but it's invisible, and you are compromising your position, and you're actually looking at things through rose-colored glasses. So we need to make sure that we include our wage for what we're worth in the market, in our fixed costs as a minimum, and we should be aspiring to get it to 3 times. So in my example, we might sort of say, well, that's 100K, right? But the truth of the matter is that that's not taking risk into account. So we need at some point in time to be lifting that number right up to 300K. Now, the question is when, and the question is how much does the new break-even look like? And so what's the minimum amount we can deal with? Now, what I'm going to suggest is when you do your budget for your business, the first thing we need to look at is the size of our target or our market. Now, in marketing terms, this is known as the total addressable market, TAM, right? And we need to look at that market and say, based on our current infrastructure, how much market share can we get? And what we're aiming to do here is we're trying to work out this thing, which is known as maximum utilization. Now, maximum utilization is where we're using all of our resources to their maximum capacity. And what that looks like, I'll give you some simple examples. I was working with a hairdresser once upon a time, and first question I always ask when we work with someone in business is, what capacity are you running at? And she said she's running 90%. Now, 90% was because she said we're booked out all the time and we just have no-shows or people who cancel last minute, and that's the reason we're at 90%. And I asked a few questions. The first one was, how many hairdressers do you have? She said, we have 4, including myself. So she was one of the employees. I said, fantastic. Tell me about the salon. How many seats do you have in the salon? She said, we have 8. And I said, well, what's wrong with the other 4 seats? And she said, well, you know, it's really hard to find good employees these days, so we just can't fill them. So what she thought was 90% was actually 45% of maximum utilization of resources. So what we did is, with her profit targets, we actually started thinking about how do we fill those seats and what would the business look like if we had 8 hairdressers. More importantly, 8 hairdressers that were not her. Right? Now, this has happened in businesses that we've spoken to over the years many, many times. And sometimes this figure scares the living daylights out of people because of the amount of waste within their organization. So what I want you to do as a result of watching this video is I want you to work out what is the maximum utilization that you have, like what's the capacity of your current resource, and does the total addressable market actually, is it big enough for you to fill that utilization? Because what we're doing now is we're working on profitability, because here is where the greatest profit as a percentage exists in the business. Now, even if we added these expenses, this overhead of fixed costs, it's still the maximum profitability on the resources we have. That means all of our resources are being used to their capacity. And when we're doing our budget, right, when we're budgeting for a profit, it's not about revenue, it's about profitability. And we need to be realistic with what we can deliver, like what our capacity is, what the market allows us to deliver, which means capacity of the market. And it creates a bit of a gap into how do we fill this capacity, which is a much better strategy than looking at last year's figures and saying, well, let's see if we can increase by 10%. Because what we're looking at now is maximizing the utilization of our resources. So I need you to do this little piece of homework. It's not overly difficult. I want you to work out how many clients can you handle, and does your total addressable market actually exist with the people that you're selling to? Because if it does, this number should excite you, because what it'll show you is how much you're leaving on the table, because every cent of revenue over break even is highly profitable. And for most people in business, all they're working on doing is paying their bills rather than making a profit. And remember, in business, it's not about turnover, it's about leftover. And we need to count the work we do in our business as a cost of sale or a cost of running the business, so that we've got a realistic profit target. Now, for some of you who are smaller, this may seem foreign, but the objective is to move towards this. So this is not a 12-month target. This is a target that we actually have to set a time frame on based on where we are. So do the mathematics, do the exercise. If you need any help with this, reach out. I'll also include in the notes underneath this video a break-even calculator so you can chuck some numbers in there and understand where you stand with this. If you need any help, just let us know. Cheers, guys.